Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures rebounding this morning after the major averages sold off in Tuesday's trade. Despite the modest pullback, stocks are still trading near record highs. The S&P 500 has now gone 107 sessions without a drop of at least 2%. That's its longest stretch since July 2024. Tech stocks bore the brunt of selling on Tuesday, but they are rebounding amid some renewed AI optimism. Some of that is coming from Micron earnings. The memory chipmaker gave an upbeat outlook driven by demand for AI equipment. Shares of the company have nearly doubled this year, and the latest results are further bolstering investor optimism. We're seeing a little bit of wavering in the shares after that big run we've seen this year. And Alibaba soaring to a 4-year high after unveiling its AI plans. CEO Eddie Wu said the company will ramp up AI spending above an original target of $50 billion. The e-commerce giant made the announcement at its annual technology conference. It also revealed a software partnership with, of course, Nvidia. Let's get a check-in on stock futures here this morning. So all three major averages pointing to a slightly higher open here. We've got the NASDAQ leading those early gains, indicating a rise of about 0.25% at the open, but the Dow and the S&P 500 participating as well. Let's dig into our top stories of the day. Futures are indeed higher as stocks look to recover losses from that prior session. Plus, Jay Powell keeping his options open as he warns of the Federal Reserve's, quote, challenging situation, and Alibaba soaring as it bets big on AI. Joining me now, senior reporter Brooke DePalma live at the NASDAQ, Federal Reserve correspondent Jennifer Schonberger, and Morning Brief Market Sunrise host Ramzan Karmali. Let's start with you, Brooke, and looking at this backdrop for stocks where, yes, we saw some wavering yesterday, but now perhaps a resumption of that push to highs.
Julie, we were on quite the hot streak there, record-setting hot streak, especially heading into Monday's close. And after we did see that momentum, the third straight day of record high closes on Tuesday, we did see all three major indices slide slowly, slightly lower than those record highs, all closing in the red on Tuesday afternoon. And now you can see here we are gaining some momentum this morning, largely led by Micron, largely led by this AI trade rally, and some renewed optimism that the Federal Reserve will cut interest rates in this year. We did hear from Fed Chair Jerome Powell on Tuesday, and he did suggest that equities were highly valued right now. And so investors really tried to digest that. That led to a lower close on Tuesday, and now we're seeing some renewed optimism to kick off this Wednesday's trading session.
Yeah, and let's talk about some of the sources of that optimism, guys. Ramzan, there has been this interesting sort of stutter start, if you will, with AI sentiment, right? Where people get very excited and then they're like, wait a minute, is it really that big of a deal? And then something new happens and they get excited again. And this morning, Alibaba seems to be the upward catalyst, or at least one of them.
It certainly is. So the Chinese tech giant, it's unveiled a sweeping AI push, and it'll be partnering with Nvidia to build cutting-edge AI infrastructure and rolling out its Qwen 3 Max language model. Now, investors love the news. The Hong Kong listed stock jumped close to more than 9% higher. In fact, at one point during the day, it hit a 4-year intraday high as well. And keep in mind, trading volumes in Hong Kong were pretty low because, much lower than usual anyway, because the city's bracing itself for the impact of the super typhoon Ragasa as well. So that's even more impressive. And as you can see in the pre-market, ADR shares, they're up almost 9% in New York as well. Now, Alibaba CEO Eddie Wu said that demand for AI has blown past expectations, and he's pledged to invest $50 billion for global expansion. But like other Chinese companies, Alibaba does face a bit of a dilemma over access to Nvidia's AI processors, which they need to train advanced models. Now, Beijing is pushing the country's tech firms like Alibaba to wean themselves off Nvidia's AI chips, nearly all of which are blocked by US export controls. It's also worth noting that Alibaba's ADRs, which are listed in New York, as I said, well, they're trading back at levels from 4 years ago, but they're still about half of what they were 5 years ago. And shares in China and Hong Kong, though, definitely did get a boost overall in this news. Both the Hang Seng and the Shanghai Composite are up sharply today, And in fact, Asian stocks are trading near 4-year highs and remain on track this month for their best monthly performance in a year. I mean, Julie, who said that September was meant to be a poor month for stocks?
Yeah, well, there's a few days left. Don't jinx it, guys. Brooke, let's talk about the other AI-driven story that we are watching this morning. That is Micron. The shares initially were higher after it reported after the close. They have been wavering a little bit.
Yeah, we did get a pop in after market close on Tuesday, and now we're seeing that reverse just a bit to the downside, down about 0.5% after this run up that this company has had year to date. But the memory chip maker, which is used alongside those Nvidia chips in these AI data centers, beat on both the top and bottom line, and that did drive some renewed optimism about what exactly this momentum, this AI trade rally could be. So Micron beat on both the top and bottom line. Their fiscal fourth quarter revenue came in, as you can see on your screen, at $11.3 billion. That was more than the street had expected. Adjusted earnings also beat as well, coming in at $3.03, also higher than what the street has expected. And it was this outlook, this guidance for the first quarter that also got Wall Street excited, perhaps. The CEO saying on the call that over the coming years, they expect trillions of dollars to be invested in AI, and a significant portion of that, they say, will be spent on memory, their key business there. And there was this hope, this optimism on the street overnight. We did see 6 firms raise their price targets this morning, in the early hours of this morning. That includes Barclays. That also includes KeyBank, as well as Piper Sandler. As you could see there, most of them gearing towards that $200 price point. We also heard from Wedbush, Needham, and Rosenblatt. They also raised their price targets as well. And I do want to point out that Rosenblatt now has the highest price target on the street of $250. And if you take a look at where the stock stands now at $165, that would be a $100 additional value. And so really waiting to see this momentum that continues behind this stock. As you can see, it's had quite the rally, especially over these key summer months.
Yeah, we're going to dig more into what the company is doing in the next hour. And then we also have to talk about a speech, or speeches, I guess, that happened yesterday. We were talking a lot about Jerome Powell and his speech, but there were also some other Fed officials that we need to talk about as well, right, Jen?
Yeah, that's right, Julie. Fed Chair Jay Powell not offering too much new in his speech on Tuesday, very non-committal on the policy front, reiterating that the balance of risks have shifted, and that's why the Fed cut rates. Rates are still modestly restrictive, and that the Fed's not on a preset course. Powell reiterated that given the challenges to both sides of the dual mandate, both on employment and inflation, there is no risk-free path for policy. But perhaps the more interesting remarks on Tuesday came from Fed Governor Michelle Bowman, who said she is more concerned about weakness in the labor market and the economy, less concerned about inflation, and wants to take preemptive action to support the job market. She said she's gaining confidence that the impact of tariffs on inflation are not going to lead to longer lasting inflation. In fact, she said she thinks lower immigration could actually push down inflation, an argument we have heard from new Fed Governor Stephen Micron. But she warned that the job market has become fragile and could deteriorate significantly, those are her words, in the coming months. And I just want to read a passage from her speech yesterday where she said, quote, "In my view, the recent data, including the estimated payroll employment benchmark revisions, show that we are at serious risk of already being behind the curve and addressing deteriorating labor market conditions. Should these conditions continue, I am concerned that we will need to adjust policy at a faster pace and to a larger degree going forward." So all eyes on her and perhaps that next jobs report due out on October 3rd. Bowman also went as far as to say that the Fed is too data point dependent and that data is inherently backward looking and can put the Fed behind the curve, and that the Fed should be more forward looking, an approach that she plans to take and one that the administration has also been pushing for.
Guys, thanks so much. A lot to consider here this morning. Brooke, Jennifer, Ramzan, appreciate it. Coming up on Morning Brief, we'll bring you today's top trending tickers as we count you down to the opening bell. Don't go anywhere. Now Now time for some of today's trending tickers. We are watching Lithium Americas, Oracle, and Acadia Pharma. First up, Lithium Americas. Those shares are surging following reports that the Trump administration is pursuing a stake in the company. The White House proposed taking equity in the lithium producer during a renegotiation of the terms of a $2.3 billion loan extended by the Energy Department. That's according to Bloomberg. Those shares are surging by 66%, and we're seeing a lift to some other lithium miners as well. Next up, Oracle, the company reportedly looking to raise $15 billion from corporate bond sales, according to Bloomberg. The software maker is selling debt in as many as 7 parts, including a rare 40-year bond. The deal comes as Oracle begins to fulfill massive cloud infrastructure deals with OpenAI and Meta, which are boosting the company's expenses. In the next several years, it's projected to spend hundreds of billions of dollars to rent and power data centers. And finally, Acadia Pharma. Those shares are sinking after the drug maker's rare disease drug trial failed. The late-stage trial of its investigative therapy to help treat hyperphagia did not meet its primary endpoint. Stifel analysts say the trial failure removes one of the potential upside drivers for that stock, and those shares down 12%. Meanwhile, shares of Soleno Therapeutics, which currently markets a drug to treat hyperphagia, did jump on the news. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, big AI names took some losses during trade Wednesday, with Nvidia and Oracle recovering pre-market after both closing lower. My next guest says announcements of major deals between those companies and OpenAI could be fueling what he calls a potentially epic bubble. Joining us now is Joe Hegener, Asterozoa Capital CIO. Joe, thanks for being here.
Thanks for having me.
So it's been really interesting to follow this AI trade. We've seen, as I was talking about earlier in the show, sort of a waxing and waning of sentiment, right? This is going to be the biggest thing ever. How could it possibly be? Oh, all these companies are spending money. They're spending too much money with, So it seems like we're in another one of those waning or at least questioning phases. Is that fair to say? And do you think it's valid to question the whole structure of the thing?
Well, I definitely think it's valid to question the overall structure and the phenomenon that's taking place. We're drawing a lot of similarities between what's happening now and, of course, .com. That's not necessarily a new reference. But the thing I think is particularly interesting, right, is just the timing of market bubbles and what brings them to a halt, I suppose, right? The .com era, the only thing that really popped or burst that bubble was the Fed raising interest rates, right? And kind of that led to the epic crash. But for years, there were commentators and professionals and analysts from 1995 all the way to 2000 that were pounding the table saying, we're in a bubble, we're in a bubble. And they were right. But if you got short in 1995,
right.
You didn't exist by the 1999, and you missed out on 40% plus equity market returns for years to come. And so that's the interesting thing I think that's taking place now is I definitely think we are in a bubble. And so, what do you do at this stage, right? Because we just cut interest rates. And we're looking at cutting more, and there's fiscal spending coming down the pipe.
Right, so there's nothing externally necessarily that would burst the bubble.
If anything, I feel like we're about to pour some gasoline on the fire. And so that's what gives us a little bit of pause, because I definitely think the left tail scenario, the risk to the downside is immense, because by any measure, valuations are very stretched. We're seeing all sorts of these circular deals that we saw in 1998 and 1999 with some of the same players as we're seeing today. And yet it's very difficult for me to actually get bearish right now, because there are so many positive catalysts as it relates to kind of pushing this sentiment towards more extreme levels.
So, and you're on the credit side of the equation, right?
Mostly on the credit side, yes.
So how do you then play it? I mean, and you mentioned some of the same players like Oracle, which, experienced the bust in the .com era, but they're still around and they're back and they're bigger than ever. Like, do you go in, we just talked about their bond sale. Do you go in and, is that an attractive offering?
Well, I would argue absolutely not, but it's just not necessarily anything to do with Oracle. It's just a function of credit spreads broadly right now are near the lowest they've ever been in history. And it does look like we're seeing some macroeconomic deterioration in jobs data and things along those lines. And a $15 billion investment grade issuance at SOFR plus 40 basis points is just not compelling to us.
I want to just translate that for people who are not steeped in the credit market. So basically, you are not getting paid
Exactly.
as an investor to make these investments right now, is another way to put that.
You're getting paid, yes, exactly right. You're getting paid 40 extra basis points per year in yield over treasuries to assume the credit risk of a corporation that could not exist in 10 years from now. And it's very difficult to say. I mean, if you asked me or any professional in 1995 if you thought BlackBerry was going to be around in 10 years, I mean, most people would probably say they'll for sure be around. And there's all sorts of things that could happen over the long haul. And so when you're thinking about credit risk in particular, you just want to be a little bit more discerning. And so the way that we're kind of looking at that or playing that is we're actually playing mostly on a relative value basis. And so, we can buy credit default swaps that effectively would be you'd be short the credits that you don't like.
So you're basically buying insurance against the company defaulting on its debt at some
Exactly. The beautiful thing about that instrument is that the lower credit spreads go, the smaller your insurance premium is for the protection. And so as they get lower and lower and more compressed, it costs us less and less to buy them. It's that old saying, right? Buy insurance when you don't think you need it.
And so how do you end up making money on those then?
Well, it's a relative value. That's a great question, right? So if you give me $100 and I buy $100 worth of bonds and the yield on that is 8 or 9%, I'm happy to take 1 or 2% per annum of that to purchase protection on the credits that I don't like.
Gotcha. Okay. So that's how you're looking at things right now. How does what the Fed is doing, how does that feed into all of this?
Oh gosh.
In 20 seconds. No, I'm just kidding.
So I think that there's an enormous amount of risk over the intermediate to longer term as it relates to the shape of the yield curve in terms of the polarity that seems to exist within the Federal Reserve right now. There are a handful of people, and I'm kind of in this camp too. I think it's very hard to argue that financial conditions are tight when crypto's going parabolic and equity markets are all-time highs, and there's what did Powell say in his presser the other day? It was effectively Greenspan's version of irrational exuberance. Stock valuations are elevated, I think he said. The jobs data, while deteriorating, it's unclear to me how much of that is a function of efficiency and productivity gains, right? If I'm a law firm and I don't need the 100 analysts anymore because I have AI embedded tools and I don't hire as much, I'm immensely more productive and my equity value is actually going to be significantly higher, but the jobs data is going to be weaker, right? And so there are structural changes that are taking place in the economy that could lead to weak economic data or weak jobs data, but it doesn't necessarily imply that changing the interest rate at the Federal Reserve overnight rate is going to do anything to adjust that or fix that. If anything, you're just going to pour gasoline on that fire.
So you think there's a risk to them continuing to cut rates?
Yes, definitely. And I think we'll see that. And if that is correct, we'll continue to see the yield curve steepen, the long end of the curve start to go higher and higher as the front end comes down.
And that also, to your earlier point, maybe extends the bubble even further.
Yes, I do. And I do also think if the long end of the curve continues to march higher, we'll see some sort of yield curve control via Besant or maybe even the Federal Reserve, who, Trump's going to install the new Fed chair in not too long of a time from now. And he's already had significant influence on, who the Board of Governors are.
Right.
And so it could be a very different Federal Reserve in a year from now than the one we're seeing today.
And just briefly, yield curve control, what would that look like?
Well, there's a number of ways to play that out, but effectively, right? But there's, a government or a central bank would implement that if they don't like long end, the trajectory of long end interest rates, right? The Fed can only control the overnight rate, and then the rest of the curve is extrapolated out via markets. But you can take a bazooka and go buy hundreds of billions of dollars worth of 30-year Treasury bonds and force the 30-year rate lower. You could also, and they've already mentioned this publicly, you could deregulate the banks to where you could encourage or facilitate the large banks in the U.S. to be purchasers of long-end Treasury bonds to increase demand, to lower interest rates. So there's a number of tweaks, and if anybody's going to do it, Scott Bessent is the guy. He understands capital markets so well that if he wants lower rates, I'm not necessarily going to bet against him because he's got a lot of levers at his disposal.
Okay. Gotta leave it there, Joe. Thank you so much. Sure. Interesting. All right, coming up on Yahoo Finance, opening bid, our executive editor, Brian Sassi, is joining us now to give us a little preview. What's coming up?
Julie, really interesting chat there. Thoroughly enjoyed all the chat on credit. But as for opening bid, I'm staying on the AI trade. I think this notion that we are near peak AI capex needs to be completely tossed in the trash. Look at that good news out of Micron and Alibaba overnight. Good stuff indeed, Julie.
Looking forward to it. Thanks, Saz. That's it for Morning Brief. Much more ahead on Yahoo Finance.